Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, October the 12th, and wanted to take just a brief minute to discuss what markets did last week, with the S&P 500 being the only index last week in positive territory, up 48 basis points, or up 0.48%. The mid cap index was down 1.87% on the week, and the small caps, as measured by the S&P 600, were down 2.4% on the week. And really, what we've been talking about since last week has really been the driver for equity markets moving forward has been interest rates. Now, Friday we got a very, very, very strong jobs report, which allowed the market to start broadening out again. And what you really saw in the beginning part of last week was that return to the very small magnificent seven growth names that had been working. And that's really the only things in the equity markets were working last week. You got the nice day on Friday. But as we've come into this week, the market, the yields have fallen down, and now the 10-year has gone from 480 last week. It's now trading, as we're speaking right now, around 466. It got as low as down to 4.5% this morning, but we did get a CPI report today that was hotter than expectations, up 0.4 month over month, with the expectation of up 0.3, giving us headline CPI at 3.7%, core CPI at 4.1%. The encouraging news about the core is it's down from last month's 4.3, so you're continuing to see that core fall, and that is the core number is more what the Fed is looking at more than the headline number. And as long as it continues to fall while rates remain where they are, we believe that the Fed very well may pause in November to allow their restrictive policy to continue working and bringing inflation down. So what we're excited about at River Place is we're finally going to start getting some corporate earnings, so we can really start to understand the fundamentals of the equity markets and how companies are really doing, how the economy is really doing, and what the forecasts are for future growth prospects for these individual companies. See, what we've had for the last 2 weeks is we've been in these quiet periods where there's not been a lot of news, so you have very volatile moves based on these interest rates, and you don't have as many buyers and as much liquidity in the equity markets that we've had over the last couple of years, which leads to larger moves both on the up and downside. So, because a lot of retail investors are still sitting on the sidelines in money market accounts making 4 to 5%, saying we're just going to see how this all plays out. If we do get a soft landing, if we don't get a soft landing, I'm just going to park my cash over here. And what we also have to realize too is September is seasonally, historically, the worst month in equity markets. October, November, and December are seasonally the strongest months in the equity markets for the fourth quarter. And we're seeing that play out as we were oversold last week. And you've seen the market be positive this week, all 4 days so far this week as yields have moved. Even today on the hotter than expected CPI report, equity markets are off their highs of the day, but are still positive as we're talking right now. And that's in the face of everything that's going on geopolitically in the world, and everything that has happened is that what's happening in our markets is more focused on interest rates than the geopolitical situation across the world and the horrific events that happened last Saturday. And just know that that's what's happening in the equity markets here is interest rates are moving everything. But what we're going to be looking at is starting Friday, we get the big banks, and we're going to be looking to see what they're putting away for loan loss reserves, because that's going to give us a guide of what the banks see of the health of the consumer moving forward and economic conditions moving forward. We're also going to be paying attention to their guidance. As you know, banks have been one of the worst performing sectors and have really been hit hard since the SVB and Signature Bank failures back in March. So that's what we're really intensely focused on here. And what we really see is that the fundamentals are going to be what drives the equity markets moving forward, which is encouraging to us. And we do believe that the economy is still strong and that earnings are still going to hold up just fine. So if you have questions about how to navigate this time or how to prepare yourself for earnings season, call us. We'd love to talk to you. You can reach us at 904-346-3460, or as always, you can reach us at riverplacecapital.com. Have a wonderful rest of your week. Thanks so much for watching.